Hey everyone. Just recording the business cycle one today. Sorry it took me a little bit longer than I expected. Started going through it and I started revamping most of my macro framework as well with it. This is a pretty cool one. This probably will become two parts just because of how long this took me to put together, how many things I kind of had to do. But basically, it's a good overview of the business cycle and the macro process of kind of understanding what phases we're in, what regime change means. We talk about these terms all the time, and there's so many people in trading who have all these different frameworks. And you go to a page and you're like, oh, this is a cycle, and 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 nobody really knows what that means, and nobody exactly explains it. So let's kind of go through that today. Starting out the business cycle, what I wanted to show you first is you see all these charts all the time. You see the business cycle here, you see equilibrium, you see economy growing, you see economy contracting, you see the amount of years it is, which is all bullshit, to be honest. Like that's completely not true. You are never going to know the exact amount of time, the exact amount of trend, the exact amount of anything in the business cycle. You are, however, going to learn today how I at least identify some of these steps. Martin Pring was one that I always actually really liked. Now he has a lot of books on this subject. He has a lot of free research online too. So if you want to take a look at that, there's some really great stuff. But he has probably the one that I like the most. And when I had these conversations about relative value with my uncle years ago, it's kind of the same type of framework. Obviously, very different people, very different ideas, but I always think of this as kind of a similar idea to what he always talked about. Basically, starting out stage one is buy bonds, stage two being buy stocks, stage three, and this is kind of when we get into the overheating phase, we want to buy inflation sensitive assets, meaning energy sector, oil, all these different things, usually starting out with a little bit of gold and then transitioning to oil, copper, and so on. And you'll notice that it also says economic contraction. So this is different than what normal people would say. Normal people would say, okay, well, the GDP is doing well, I better buy stocks. This is doing badly, I better sell stocks. So as we're kind of looking at these two things and going, okay, we need to buy stocks at this time, sell stocks at this time, buy commodities at this time, we're learning that most of the time the market is forward looking, and being that it's forward looking and being that we're in a contraction or an expansion at certain times, we need to kind of understand where we're going, what we need to be thinking about, and what we need to be identifying from there. And most of the time we can kind of see this from a trend angle. Now, this is some other things I just posted on here to kind of show what we're talking about at times when we're talking about these cycles and different waves and so on, and how it gets extremely confusing, quadratic of waves. And I've studied all these and went through all of these, and yeah, it's interesting, but how exactly do you make money on it? And the real truth of that is that you really can't. It's very hard to make money on something where you're going, okay, well, we're running these perfect waves and, it's going to be 4 to 5 years or 10 years or something. It's all bullshit, to be honest. So today we're going to really focus on how we put this together in a way that can be profitable. Starting out right here, this is the presidential cycle. So if we're looking at the presidential cycle, this is year one of the presidential cycle, year two of the presidential cycle, 3 and 4. And most of the time what you'll see is the third year being very, very profitable in the stock market. This is just another cycle. Once again, it's not a timing tool. There's no timing tools here. This is kind of a, hey, if we're in this type of pattern, this is something we might want to look at, might want to understand. Are we in an uptrend? Are we in a downtrend? What's the Fed doing? And so on. And if we're in this type of cycle that things are kind of unwinding, we can have a good scenario where we get into, and people would talk about 2019, for example. That was the last third year we had. And 2019 was absolutely a melt up. We had a really good year that year in the markets. However, we did have a lot of the Fed was raising rates, and it topped out at a certain point. The market had a huge crash, correction, whatever you want to call it, in the end of 2018. I would call it a crash just because of how fast it was. And then moving into 2019, we saw this run that was very strong in the market, tech leading. You know, we had a very interesting market at that point. Bonds were also running. So, you know, that's something that we could see, but we really want to understand where we are in the cycle, what regime we're in, what we need to be buying, and then move from there. Now, this is the concept of relative value. I talk about this a lot. I don't know if I've ever really explained it. What I think of relative value is the big picture. What are commodities compared to stocks? You know, are we at because that's the thing, at the end of the day, investors, we're always looking for a place to put our money where it's going to be treated the best. And so if we're looking for somewhere where our money is going to be treated the best, we're going to go, okay, well, you know, what's the value compared to blank? What's the value? And most of the time, if you are an investor and you are a trader, or you're some person who's in the market more than just putting your money away into a retirement account and walking away, your whole point of it is to outperform the stock market. So looking at that, we can kind of understand where we want to be. Now, this doesn't mean we need to just buy oil or something. You know, this means that we could buy something like, you know, copper miners, gold miners, you know, you name it. You could buy many different things and kind of just get an understanding of where you're going to want to be positioned in the market at that time. And so right now we're looking at this and going, okay, well, you know, what is the major part of the cycle? And so to me, the major part of the cycle is seeing that we are kind of running into this commodity cycle. You know, we are kind of running into this commodity driven bull market coming up here. And I still think that we could be in that. You know, we do see that we started to get a run in some of these commodities. Some of the times they did look really good. But this is not going to be a perfect cycle, right? Like nothing's going to be perfectly going up, nothing's going to be perfectly going down. So I do see that over a long period of time, kind of similar to something like, you know, 2000, is where we could see this heading more towards a commodities complex. But in the meantime, I think that we get back into more of a phase one part of that cycle, meaning we're going to go back into bonds. Commodities are going to be flat. Not saying they're all going to go down, but I'm saying commodities are going to be flat. Maybe something that, you know, is going to signify a growth period or something coming up could be a good commodity to talk about. Obviously, gold is a commodity, but you know, in this equation, it's a little bit different. So I want to think of gold as something that's going to do well as real yields come down. And so most of the time, as yields are coming down or real yields are coming down, bonds are going to be somewhere we're going to want to be. Tech is also going to be one of the first sectors to perk up. So if we're looking at those things, we can see that, okay, maybe right now is a good time to kind of start looking at getting to the long side of some of these things like bonds, some of these things like some of these stocks like the tech sectors, some of these more yield sensitive stocks are going to start doing well. Banks do not do well in that type of environment. So we're going to want to try to understand the concept of relative value and where we're going to want to be in the stock market going forward. Now, I've talked about this strategy a million times before. And basically, this is Faber Strategy. This is not my strategy. I did not create it. I have nothing to do with it, but there's a lot of traders, investors, and so on have looked to this guy's work. And there's a couple different people over time that you see that have really great work on relative strength. Faber being one of them. And he has a lot of white papers out there, so please feel free to you know, go through some of this research as well. And basically what we're showing here is that, you know, non-durables, durables, manufacturing, energy, tech, you know, basically all the sectors, we're seeing like what their returns are over time, year over year, what, you know, their max drawdown would be over this period of time. This is all the way to 1928 to 2009. So remember, there's a 1929 crash here. That's why you're seeing a lot of these 90% down, but that's also very possible. You have to remember that's a possibility. As long as you're looking in the market, you can have massive drawdowns. You can have 80%, 90% down years if you're buying and holding. This has happened in history. It probably will happen again. So looking at that and going, okay, well, you know, average year over year, this is, or every year, what the average is, we're making decent money in all of these. And so basically this is the chart of the strategy. So this is buying and holding. That's a broad market. And this is the strategy that we're going to look at with Meb Faber. And so the strategy with Meb Faber is here, meaning we're rotating into the top 4 sectors. And basically what we need to do is look for this trend filter, meaning when we're above the 10-day moving average, we're buying the top 4 sectors. When we're below, we're not buying the top 4 sectors. We're going to be long something like treasury bonds. And so that's the way his model works. So I put down here as well the buy signal by the top, sorry, not 4, 3 sectors with the biggest gains over a 3-month time frame. When the S&P index is trading above its 10-month simple moving average, the sell signal, sell all positions anytime the S&P index falls below the 10-month moving average. And so basically the first part of this, he just basically buys and sells those sectors with nothing in between. He goes through a couple different ways to use this, showing things like buying treasury bonds, buying gold, buying different assets. There's lots of different ways to use the strategy, but this is kind of an interesting understanding of relative strength. And this is also important for relative value and understanding where we're at in the cycle. If you don't know that, broadly tech is outperforming right now, you don't know exactly that, hey, this is also why is tech outperforming? Well, you got bond yields dropping. Why is gold outperforming? Well, you got bond yields dropping. Everything is connected in the macro space. So we're going to keep going through that. Last 3 months. So basically I'm just showing you guys some relative strength models. This is RRG chart. These are on stockcharts.com. It's a very cool model. Basically kind of shows you the last 3 months, what the tail looks like, where you'd want to be in the market. And we're seeing that XLY, really that's tech sector. And honestly, it's really dominated by Amazon, which is, kind of just understanding where most of these things are is very important. It's not something we really need to go into right now, but most of these are in. This is in Amazon. This is Microsoft and Apple. This is a lot of Google. So most of these are tech, and seeing that they're majorly outperforming the S&P over the last 3 months. S&P is up 3%. See what I mean by saying when I say this could drag the entire market up, because tech is such a heavy weighting of this market these days. So because it's such a heavy weighting, we're seeing that these have good gains. Nothing else has good gains. That's industrials, materials, real estate, consumer staples, utilities, healthcare, financials, energy, all down, and the market is still up. There's a very heavy weight in this. So I'm not saying, I like the way look at this market. This is a thin rally at the moment. That could change, but as long as it's a thin rally, this could be a rally just driven by a few tech names, and we really need to pay attention to those tech names to see if they start falling out. The last 3 months, asset allocation. So also relative strength, you can use it in the macro space. Things like the dollar, Bitcoin, high yield debt, government bonds, the S&P 500, and cryptocurrency. And so looking at that, we're seeing that, now we're seeing some of these high grade bonds are doing well. High yield corporate debt is actually doing well. That's surprising. That's basically junk bonds. Treasury bonds are doing very well. The S&P 500 is up over, and this is the EFA index, basically a world index. Bitcoin, obviously, it's up 69% compared to everything else. So that's also a good sign, telling me that there is some risk on out there. Somebody is interested in something. And most of the time, Bitcoin has this rally that kind of happens before everything else. And so we need to keep it. And I always say that let's pay attention to Bitcoin. Let's always pay attention to Bitcoin, because I can always kind of tell where we're going because of where Bitcoin is going. RRG on currencies. So that's also moving up over the last 3 months. The euro, the yen, the Swiss franc, the krona, all these things are kind of moving up. The rest of these things are starting to, get beaten down a little bit, but at the same time, this is something that we want to keep paying attention to. And to me, I'm kind of seeing this kind of shift out of the United States at the moment. We're kind of seeing a shift to other countries, developed countries as well. Europe is doing pretty well. So there is relative strength going to these different areas. And so here's the international ETFs. Mexico up 11% in the last 3 months. Spain up 8.9% in the last 3 months. France up 8.3%, and I think it hit an all-time high recently. I know the index did. I'm not sure about the ETF. Germany hit at 8.7%. So a lot of these are outperforming the US by quite a bit. Japan, Sweden, Italy, Netherlands. So as these are outperforming, I'm kind of getting a feeling that people are kind of moving to these developed countries. Besides, and Mexico is also in there as well. But a lot of these developed countries are doing very well, whereas Malaysia, Hong Kong, Belgium, Australia, even though some of those are developed as well, they're not doing nearly as well as the rest of these. So most of the time, I'm going to want to say, if I'm looking at the relative strength, maybe that's also hinting at where I want to be, but it's also telling me that, hey, money might be flowing out of the United States at the moment. So I want to keep an eye on that and be open to investing in other areas at the moment. Year to date, these are all the sectors. Once again, same thing. We went over it a little bit earlier, but tech is leading the way. This is now I've said let's combine a couple things. Now we see the relative strength. We went up over the cycles just a little bit. Now let's look at the CRB USB ratio, meaning commodities to bonds ratio. So we're seeing commodities are still almost in an uptrend. I wouldn't exactly say that's something I want to be long of. It's basically breaking down here at the moment. It's sitting in the cloud, which is why I say it's more of a neutral than just a straight sell signal broadly. But it's also saying that for me, it's telling me to be long bonds, not long things like oil, and moving on from there. So we definitely want to be interested in being long the bond market, which also tells us things about, is the bond market starting to call bluff on the Fed? That's something I'm always trying to pay attention to, because the 2-year yield really kind of dictates what the Fed's going to do. And if the 2-year yield is really taking a hit, that's a situation where we're going, okay, well, if we're looking at the Fed's fund rate futures and the 2-year yield starting to go down, and we're seeing that they're also going like, hey, they might raise rates this time and maybe one more time after that, but these are going to be very small hikes. And then it's starting to price in cuts after that. I want to pay attention to that, and I want to really pay attention to that bond market at the moment, especially if we're looking at all the cycles and the evidence that we have right now. Gold's DVC ratio. So that's DVC is a commodities ETF. I've always liked this ratio. It's something I back tested a ton just to kind of get a historical understanding of it. Basically, the red signal here means you want to buy something like oil, and then the blue is a buy signal for gold. As you see, this is really quite accurate. Like, gold, basically gold here, boom, great trend. As you saw, that's right where it bottomed. Gold bottomed, oil really sold off really hard there. And honestly, they go together, but they kind of fight each other quite a bit. So this is a very interesting intermarket relationship. It's held up for over time, which most of them do not. So I really like this intermarket relationship. Right there, it's in buy oil again. That was when we started that massive trend in oil, and see that gold started to top out there. And once again, buy gold. We're in that still. Gold looks really great compared to oil, especially. So we want to stay long gold at the moment. And like I talked about earlier, we were talking about the money going out of the US, and even emerging markets is starting to perk up. Yes, it gave some back. That did happen, but it's still holding up. It's still something that, you know, we really want to see the dollar doing the same thing. So emerging markets are never going to do well if the dollar is doing well. That's not going to happen. Economically, it doesn't make any sense. So if we're watching the dollar and we're going, okay, the dollar's in a very strong uptrend here, we're going to want to avoid emerging markets like the fucking plague. But if the dollar's trying to move down here like it is, now we're going, okay, emerging markets is interesting. And not only emerging markets, obviously the rest of the things we talked about, we're talking about Europe, other developed economies, things that are not priced in dollars, obviously. So putting a few things together now, talk about the macro combined with the technicals and fundamentals. All this together really kind of tells the story of what's happening. So, you know, this is percent of US GDP against the world. So we're seeing that this is starting, most of the time, this goes so hand in hand, it's crazy. So we're looking at this, it's moving down. We see that the dollar kind of got above trend quite a bit, which also leads me to believe that this could start moving the other direction. If other populations are growing, and you know their growth in their markets are higher than ours in comparison. Their growth in Europe is actually starting to come back. It's telling me that there's a possibility that these countries start to outperform us a little bit, and that's going to put some pressure on the dollar. China is absolutely, we went over that in the last issue, but China absolutely is starting to put some pressure on the dollar. If you add all these things together, you could say, okay, well, I want to be long some of these developed market currencies against the dollar. I want to be looking for things in the world market to be long of as well. I don't want to just be stuck in the US. And most people in the United States, we have a very big bias for the US. You know, like, you know, they always talk about English people, how they would be like, why don't you speak English? You know, because we have some big thing about just being American and having the language, and and investments. If you look at how many investors in the United States invest outside of the United States, it's a very small percentage. But if you go anywhere else, everybody invests globally. So it's very interesting to kind of think of that and kind of get an understanding of maybe right now is a good time for me to look someplace else, me to pick up some ideas in other countries, and start looking at emerging markets, start looking at Mexico, start looking at Europe, start looking at these different areas that you could put some money into. And so this next one is another chart, but I wanted to go to this Soros quote. And this is going to end part one of this. But economic history is a never-ending series of episodes based on falsehoods and lies, not truths. It represents the path to big money. The object is to recognize the trend whose premise is false, ride that trend, and step off before it's discredited. So this is what we're always trying to do. And this is the whole point of the phases up here. So as we're looking back at this and kind of understanding, like, we're in that's a contraction period. You know, when everything's going well and everything's perfect, that's not the time to buy the market. That's not the time to go, okay, the US is going to outperform forever because, you know, we're doing so fucking well. That's not the case. That with the time to start in the cycle, obviously, is when nobody likes it. Think of, you know, March 2009. There was nobody sitting there and going like, right now is the perfect time to buy the market. I mean, on TV, you know, it was the end of the world. Markets were never coming back. You know, nobody had ideas to go long. You know, there's people, you know, buying as much gold as they can and stuffing it under, you know, under their house or wherever. You know, there was stories upon stories like that. And so that was the bottom of the market. Even think as close back as you know, 2020. In March 2020, we shut down the economy, and right about at that point is when the market started to bottom and move the other direction again. So we always have to be open to these facts of that we can be in a contraction. Things don't have to look great for stocks to go up and bonds to go up, but we also want to understand that right now, I think the easiest trade is the bond trade. being long the bond market. I also think right now, another great trade is gold. And I think stocks will follow, but it's going to be just like it's been. It's going to be rocky. It's going to be tough. It's going to be volatile. All right, guys. I'll be back with part 2 probably later today or tomorrow.